this is navigating tax issues in partnerships, joint ventures, and syndications. Basically all the things about other people. Other people bring other problems. So what we're going to be talking about tonight is the issues that come along with partnerships and joint ventures and syndications and what we can do about them. And then we're going to have a little thing on at the end that's not tax related specifically, but can impact your taxes and are things to think about. Without further ado, navigating tax issues in partnerships, joint ventures, and syndications, understanding the complexities and solutions. We're TaxSherpa. You can't see her, but Serena is on the line. Can you say hello, Serena?
Yes. Hello, everyone.
So she's there, and she'll be monitoring the chat and all that kind of stuff. Let's just dive in. First thing, obviously, we're TaxSherpa. Done tens of thousands of tax returns, millions of dollars worth of payments, and billions of dollars worth of client earnings. I'm Neal. I'm the founder of TaxSherpa. And I'll give you just a quick highlight reel of me. Wow, my head is really big there. I realized early on that the corporate world was not for me. And I am one of probably relatively few people who I can pinpoint the moment that I decided that I wasn't going to be doing the whole 9 to 5 like I had been trained to for my entire schooling. I went to school for engineering, and I was interning with AMD, which is Intel's main competitor. And this was the spring before my senior year. And I happened to be there during 2000. It was like January to May of 2000. And while I was there, AMD released the first 1 gigahertz processor. And it was a big deal. Stock shot up. Everybody was happy. The company made $1 billion, whatever. Super exciting time to be there. And at the end of the term, we had an award ceremony for just company awards. And the vice president of whatever department was up there talking about, oh, Joe got 3 patents this year. Let's give him a round of applause. Yay. Everybody cheers. And cheer might be a strong word, but we all clapped. We did the polite thing. And then we go through a whole thing. The whole ceremony was like an hour long. That's all fine. And then we get to the last one. And the last award recipient, I forget his name. Let's call him Bob. And Bob had a European vacation booked with his family months in advance, approved by HR and all the stuff. And it came down to crunch time. When the gigahertz processor was released, it was all hands on deck. All the different teams had to do all kinds of different things at the last minute, from production to marketing to sales to PR. Everybody had a lot of stuff going on then. Bob canceled his European vacation with his family and decided to come to work instead. Now, I don't know how many people were on Bob's team, but it was definitely more than just him. But they were cheering him on, saying, "Isn't he such a great guy?" He put his family aside and worked for the company. He's a real company man. They're all excited and giving him a hand and all that kind of stuff. And then I at that moment, I saw this guy going up and getting his little award for throwing his family to the side, and I was like, yeah, this is not going to be for me. So my whole elementary, high school, college career, I was like, yeah, this is all just not working. And then, so that's when I started doing my entrepreneurial journey. And I see that I'm off the screen here. So let me see if I can adjust this real quick. Let's see. I'm just gonna, don't mind the live editing. All right, there we go. Now I can actually see the whole slide. So I took that and I tried grad school for a little bit. That didn't work out for me. And I went off on my entrepreneurial journey in my 20s. And that did not go well. So ups and downs and lots of downs. Tried lots of different things. And in 2007, I started getting letters from the IRS saying that I owed them $1.3 million. And that was interesting. And I looked at it and I was like, there's no way. So I just ignored it. I hadn't filed taxes in years and years because I didn't have any income as far as I was concerned. Yeah, I was just sticking my head in the sand. So then, if you haven't been through it, here's the process as it works when it comes to collections like that. So first you get letters. And then if you ignore those, they send you certified mail letters where you have to sign for a receipt. And then if you ignore those, you start getting phone calls. I got phone calls from, seemed like a very nice lady, Joyce. And if you ignore that and you're like, don't do the things that they want you to do, then they start going after all your assets that they can find. Bank accounts, cars. For me, I didn't really have much in a bank account. I didn't have a car that was worth anything, but I did have a paycheck at this point. I was getting a W-2, and they started taking that. You have your like biweekly or whatever it was, you have the total that you make, and then they have your deductions. So we'll say federal income tax withholding, Social Security, Medicare, garnishment. And whatever's left is very small. So I think they had knocked my paycheck down to a couple $100 every 2 weeks, which was a problem because I couldn't live on that. I ended up going around and trying to figure out how to fix my own problem. In doing so, I ended up hooking up with this former Wall Street tax attorney, and he helped me fix my problem. If you're curious, it was related to stock trading. I was doing some day trading, and I ended up losing money on the day trading, but I had to report it in the right way, and that's why the IRS thought I owed them so much money. I fixed my problem, although I never got my garnishment back. And over all those years in my 20s, I had gone from different businesses, learning lessons along the way. When you're an entrepreneur of any stripe, whether you're a solopreneur, contractor, or you actually lead a small team, then there's lots of different things you got to do. And I knew none of them to start with, but like in each venture, I learned another things. Like, okay, you got to do marketing. Okay, you got to do sales. Okay, you got to do admin, and just building up that skill set. So the tax attorney that I hooked up with, he was fantastic at doing taxes, but was absolutely terrible at all the other aspects of running a business. So we partnered up, and so I helped him on the operations side, and he taught me the tax game. And over the years, I've done 50,000 tax returns, like I said, on billions of dollars worth of revenue, saving clients $20-30 million a year. What I didn't know at the time was that he came from a very advanced kind of background. He used to work on Wall Street. They used to handle the specialists for the New York Stock Exchange and doing their taxes, and they came up with tax strategies that were then codified into the Internal Revenue Code and all kinds of interesting stuff. That's not normal. And I didn't really know that until years later. But that was my background. I always came up in the tax world through this kind of apprenticeship type program where the goal was not just, okay, let's write down whatever happened in the tax forms, but let's figure out the ways to save our clients as much money as possible. In 2019 and really into 2020, I launched TaxSherpa, and that's what we've been doing ever since. So that's the background of TaxSherpa. So our people really are the solopreneurs, the contractors, the small business owners, because that's my people. The other people who can't hold a job because they are unemployable, so they have to make it on their own. And so that's my tribe, and TaxSherpa is founded to help all the people in my tribe save tens of thousands of dollars on their taxes. Let's see how to do that. So issue number one when it comes to partnerships and JVs and syndications is conflicting goals. This is actually the most important thing. The conflicting goal problems are that, do you want more deductions or more profit? So normally, when we're talking to a small business owner or a contractor or a solopreneur, 99% of the time, we want to squish our taxable income as much as possible while maintaining our standard of living and paying as little tax as possible. And usually the partners go along with that, but not always. So this is usually brought on by financing. And the financing issues could be personal or business. So on the personal side, which is by far the number one issue, is houses. If one partner wants to buy a house and the other partner, and it doesn't have to be two, it could be 3, 4, however many, and the other ones don't, then we have conflicting goals. And because the more net income you show, generally, the more tax you're going to have. And if you're not buying a house, why should you have to pay the tax so that your buddy can buy his house or her house? This can also come into effect with business financing. Partner number one wants to get a business loan of some kind. Could be cash loan, could be credit, could be a lending facility, could be car or auto or fleet financing kind of stuff. So that's a little bit less common, but certainly happens. And either way, it's financing. And the reason it's financing is because lenders, they want to look at tax returns, and they want to see what kind of income you're bringing in. And they'll use that for qualification purposes as far as how much they're going to lend you at what rate and all that kind of stuff. Lending is, of the various kinds, is issue number one when it comes to these disagreements. There are other issues, but they're less common. So I will tell you a quick story about Bob and Alice. So all my stories are Bob and Alice, just so you know.
That's true.
And because we don't use real names, but I need to talk about somebody. So Bob and Alice it is. So they had a therapy business, and it was 50-50. So Bob wanted to buy a house, and Alice didn't, just like I was just talking about. And so they came into the office. This is back when we were doing in person. This is pre-COVID and everything. And we went over the options, and they said, so Bob said, my lender says I need to show whatever it was, $100,000 worth of profit here. And I said, and we ran through the analysis, and we said, okay, if you show $100,000 of profit, then that's going to make your AGI whatever it was. Bob had a spouse that worked, so there was additional W-2 income. And we figured out whatever the tax would be there. Now, Alice is a partner too. So Alice also has a tax impact from showing that level of profit, and we had to go through that number. And we discussed the pros and cons. We said, okay, we could do it this way and show the $100,000, or we could do it that way and show less, and then the tax would be less. And so we have situation A, situation B. And so we went through all those scenarios, and they discussed it amongst themselves, and they came to an agreement that they're going to show the higher income so Bob could buy the house. And so Alice agreed, but she still felt put out. And she knew, and because we went through the numbers, it's like, you're paying $5,000 extra this year because Bob's buying a house. In their case, it was a happy ending because they were great friends and they were able to work through the issue there. But that's not always the case. A lot of partnerships break up over all kinds of things, and this can be one of those reasons. It's important to understand these kind of issues. And the way that you should actually deal with it is to not deal with this directly. And I'll show you how that works. Basically, what we have here, I don't know if you can see my cursor or not, but on the left-hand side, we've got the OpsCo. This is the normal setup, 50% to partner 1, 50% to partner 2. If there's 3 partners, it might be 33, 33, 34. If there's 5 partners, 20% each, whatever. And it doesn't have to be even either, but whatever is agreed upon the creation and then management of the operating company. So what you want to do instead is create a management layer to hold your interest. So let's say you're partner 1, you're Bob here. So Bob owns Management Co. 1, and Management Co. 1 holds the membership interest or the partner interest in the operating company. And then same thing for partner 2. And so in this way, what we can do is when it comes not time to file taxes because that's too late, but when it comes time to plan for taxes, as you should be doing before the end of each year and really throughout each year. So we run projections and we say, okay, OpsCo is going to make this. And there's still adjustments to be made because there are choices to be made as far as how we expense or capitalize or deduct various expenses. Are we on accrual? Are we on cash? Do we have constructive receipt of money that's coming in next year? All these kinds of factors can really swing a tax return in any one year. And we figure out whatever the optimal thing that we want to do at the operations layer there. And then it's going to go 50-50 or 45-65-55 or 33-33-30, whatever the split is. That's going to flow up into the management layer. Then at the management layer, then we can apply individualized tax strategy. And maybe Bob wants to show more income this year to buy a house, so we apply less strategy. And Alice wants to show less income because she's not buying a house, so we apply more strategy and lower her taxable income. And that way we are separating out the conflicts, right? Because we're moving this out a layer. And then that allows us to have our cake and eat it too, where you can show whatever income you need to show at the operations layer, and then you can show whatever adjusted income at the management layer, and then that's going to come home to your 1040, your personal tax return, because these are all flow-throughs. And so it'll end up hitting your personal 1040, and it'll have whichever impact you want for adjusted gross income purposes. And then that goes to the banks, and then the banks say, oh, you're making tons of money, great, we're happy, and everybody goes on about their way. And so we're able to flex both ways individually because we have the different levers at the management layer. So that's the basic solution of how you want to hold your interest in various partnerships. And it doesn't have to be a partnership. This could apply to syndications, JVs, and all that kind of stuff as well. So that's the first issue. That's actually the biggest issue, but we'll get into some more details here. The next one is flow-through issues. So most companies are flow-throughs, meaning that the profits and losses and credits and everything flow through to the owners. So the Tax Cut and Jobs Act really dramatically changed tax impacts on businesses. You've probably heard of QBI, maybe not by that name. You certainly heard that people who own businesses get a 20% tax break. That's what QBI is. It's qualified business income. And what happens is that the qualified business income is essentially the net profit coming from an entity into your personal tax return. And there's a whole lot of stuff that goes into this, but there can be giant disasters depending on the partner's situations. If you are under a threshold, and it depends on whether you're single, head of household, married separate, or married filing joint, as far as what that threshold is. For 2023, I think it's $183,000 for single, head of household, and married separate, and then it's $360 or $380 something for married filing joint. If you're underneath that threshold, you get a flat 20%, and the threshold applies to your total income for the year. Let's say you have $50,000 of W-2, could be yours, could be your spouse's, and then you have $100,000 of flow-through income. 100 plus 50 is 150. You're underneath the QBI threshold. You're going to get a flat 20% break on that 100,000 flow-through income. However, if you're over 100, if you're over the threshold, then there becomes a means test, and the test is one test is 20% of the flow-through income. A second test is 50% of the wages paid. And a third test is based on the assets that the flow-through business owns, which is primarily for real estate people. So it's 2.5% of the UBIA, which is unadjusted basis. What does IA stand for? I don't know. It's the basis of all the assets. So, what happens is they take the asset test and they take the wage test. Whichever one of those is bigger, they take that number and compare it against the 20% of profits, and whichever one of those is smaller is going to be your qualified business income deduction. And then there's more subtleties that go in with capital gains and itemized deductions. But it's a really complex situation, and it's highly individualized. So what happens is that you might be fine at the operational level, but then different owners have different tax situations. So maybe one is below the threshold and the other is above the threshold. So they have different requirements for how that all gets played out. Similarly with guaranteed payments. So if you have a partnership specifically, one thing that you might have is guaranteed payments. It's like a replacement for salary. It's a payment that's guaranteed regardless of how the business does. And that carries self-employment tax considerations as well. Well, I don't want to go too deep into the weeds, but the bottom line is that these flow-through items can create huge issues. This also applies to I didn't put it on the slide here, but also applies to tax credits. So some tax credits carry forward. So if one partner uses them and the other partner doesn't use them, then at least the one who doesn't use them, it'll carry forward into the next year until it's usable. Other credits are use it or lose it. You definitely want to make sure that everything is flowing through to the maximum usefulness possible. And we'll do a quick story here. So this is a new Bob and Alice. So Bob and Alice have a marketing business. Alice needed W-2 income, but Bob didn't. Alice needed QBI items, and Bob didn't because Bob was below his threshold. Alice was above the threshold. So what they ended up doing before they came to us is that Alice had taken a W-2 from the operating company, but Alice actually lost half of the benefit because the W-2 allocated to the profit gets split. It's the total W-2 paid by the company. So half of that W-2 assignment went to Bob because Bob was a half owner. And so when Alice went to calculate her QBI deductions, she was only seeing the benefit of half of the wages paid. Now, she was the only one getting a W-2. Effectively, she was gifting Bob this W-2 basis, which Bob didn't need at all anyways. And it was just a disaster. And what do? We did what I said before. We addressed it at the management layer. We restructured their ownership, and had them contribute their membership interests into management companies. And then we assessed the W-2 issues at the management layer. And so these kind of issues are of QBI and guaranteed payments and tax credits. They are highly individual as far as what is optimal for you. And so that creates the need for individualized planning. That's just the short and sweet of it. The goal here is to create strategy at the management level and optimize those flows there. And again, just like we talked about before, the operating company can do whatever it does. The net income or net loss flows up to the management layer, and then we adjust there as needed to optimize for each individual owner. And that's how we fix it. So you need the structure first, and then once you have the structure, you can apply the strategies and pull those individual levers as needed. All right, so that is flow-through issues. And a big one is minority interests. So minority interest is what you have if you are a less than 50% partner. And usually it's way less. Usually it's 0.5%, 1%, 5%, that kind of thing. So there are two main problems. There's a lot of problems, but there's two main ones. So primary issue is no control because you're a minority. You can't outvote the majority owners. And the secondary issue is limited redress, meaning that even if something crops up, your ability to change that or affect the outcome is limited. So that is the secondary problem. I've seen this so many times, but basically, here's a quick story. We got a third Bob here. So Bob was a minority owner in a real estate syndication, and Bob got a K1. So K1 says $3,000 loss. Okay. A couple months go by, Bob gets a second K1. This one's an amended K1 that had a $39,000 loss. And what ended up happening was that whoever was the partner in charge of doing the tax returns, they got the original tax return and they're like, okay, whatever. And then said, maybe we should do cost segregation. So they went in and they did a cost segregation study. So if you've never heard of this, cost segregation is super powerful if you are an active real estate investor. And what it is you buy a piece of property. It's not one thing, right? So let's say there's a house. You're not buying just a house. You're buying a piece of land. You're buying a driveway. You're buying a sidewalk. You're buying landscaping. You're buying a building, but not just a building. You're buying wiring. You're buying ceiling fans. You're buying cabinetry. You're buying appliances. The list goes on and on. So what a cost segregation study does is an engineering firm will come in and they will assess all these different things. And they will break them out into different categories. And that's the segregation part. So we're segregating the cost from one thing into multiple things. The advantage of doing that is that about 20% of the non-land cost, land is not deductible at all, or is not depreciable at all. The non-land cost usually falls about 80-20. 80% goes to the building and 20% goes to these shorter term items. They could be 5-year property, 7-year property, 15-year property. And when I say 5-year property, that means it's depreciable over 5 years. If you couple that with the Tax Cut and Jobs Act, which was Trump's tax reform, and a lot of those categories became eligible for bonus depreciation. And the short version of what that means is that we could deduct the whole thing of those shorter term properties in the first year. So you buy a house for, let's say, I don't know, let's make it realistic, $400,000. Let's say the land is $100,000 and the everything not land is $300,000. So $300,000, 20% is $60,000. So we get a $60,000 write-off in the first year, and then the remainder of the $300,000, the $240,000, gets depreciated over 27 and a half years. So that's $10,000 a year, let's call it. So getting that deduction up front has huge swings on the taxable income. So you can see in this one, Bob only owned, 2.5%, and this was a commercial property, but his net profit went from -3 to -39. And it was an AAR, which is a particular form of adjusted report, and it's a giant pain to deal with. And it took us quite a while because there was conflicting state and federal stuff. It was a whole thing. We got him sorted and able to claim the revised deductions. So that was Bob's story. In Bob's case, he wasn't going for financing or anything, so it didn't hurt him. It was just lowering his other income, which worked out okay. The problem is that he had no control over it. And he had even after they did the adjustment, it's like they asked him, they just said, here you go. He had no way to to affect the outcome, and he just had to take whatever they gave him. What's the solution? The solution is 1, due diligence, and 2, planning. So when you go into a deal where you're going to be a minority interest, you have to know that you're not going to have any control. So you want to know what the expectations are. What is cash flow going to be? What kind of assets are we doing? What tax planning are we doing? Are we going to do tax, or are we going to do cost segregation or not? And all these things need to be written down. They are worth the paper it's written on. So if it's just a verbal thing, that's not going to hold up for anything. It's got to be in the operating agreement. Say, okay, partner 1, who Joe Smith, is responsible for tax strategy, and Joe Smith is going to apply these tax strategies based on consultation with their tax advisors towards whatever assets that we're buying. And the assets are going to be this, that, and the other kind of type of assets. Could be, there's all kinds of syndications. Could be ATM machines. The big one that's popping up lately is Bitcoin ATMs. You can buy a share of a Bitcoin ATM portfolio. It could be real estate. It could be any other type of business. You want to know what is going on the way in, and then you can work whatever that plan is at the entity level. Then you need to be able to work that into your personal plan. And how does this fit with everything else going on in my tax life? And is it going to increase my tax, decrease my tax, stay the same, whatever? But you got to incorporate all those elements into your individual plan, because, like I've said, everybody's needs are unique and everybody's situation is individual. So that is the key. Is once you're in it, it's too late, right? I was just talking to a guy last night, and he was telling me about somebody he knows that's in a partnership, and we'll get to that in a second, actually. I don't want to jump the gun here. All right, this is our bonus round. So we've been going for a little over 30 minutes. I don't want to make this one too long, but operating issues. So this is our bonus. There's the 5 Ds. 5 Ds. These are critical to remember to any partnership. And this book on the right-hand side here, this is Fast Track to Millions, How to Profit Through Partnerships. It's my buddy Mike, who's been very successful in partnerships. But you got to be aware of the 5 Ds. And the 5 Ds are death, disinterest, divorce, drugs, disagreement. A lot of people, not even a lot of people, let's say a significant number of people, but less than half, think ahead in terms of disagreement. They say, okay, if there's 2 of us and we're 50-50, what do we do if we have a disagreement? Maybe we go to a third party that we trust. Maybe we go to arbitration. Maybe we go to mediation. Maybe we flip a coin. Maybe we play rock, paper, scissors. Anything, right? So that's the one of the Ds that people do think about. But the other 4, nobody thinks about. And what happens if your partner dies? What happens if you die? Where does your membership interest go? Do you have heirs? If you do have heirs, what are they going to do with it? Do you have 3 heirs? And now your buddy Joe, who had one partner, who's now gone, now has their 3 kids, each one owning 1/3 of 50%, and they can't get along, and it could just be a disaster. You got to have a plan, and it could be life insurance. It could be you have a buyout clause that's automatically triggered upon death. There's a lot of different ways to handle it, but you got to think about these things and determine what are the scenarios, what are your options, and what do you want to happen. The other one is disinterest. So you start a business, you're both super excited, or all 3 of you are super excited, whatever, and a couple years go by, things are going okay, and it's not exploding the way you think it is. Somebody becomes disinterested, and they're not pulling their weight anymore. What is your recourse? If you want to stay in the business, what's your recourse for the people who are not pulling their weight? If you're one of the ones who wants to get out, and this isn't going the way you had planned, then what's your option for unloading? My buddy that I was talking to yesterday, he was telling me about a situation where somebody he knows they're in a partnership. The business is actually doing well, but the partner is just, not that he's not working, because the business is working and they're making money, but you just can't deal with him anymore. It's just personality conflict. And that happens. He wants out. And apparently all he wants is just the money that he put in returned. But his partner gave him some crazy lowball offer. And they're right now they're stuck because they're 50-50, and they didn't plan any of this out ahead of time, and they want to go their separate. One wants to go separate ways, and the other one says, "Okay, give me your stuff." So, no, I don't want to give you your stuff. I want some money for it. I don't want to give you money. So you need to plan these things out in ahead. So maybe they could have had a shotgun clause. The shotgun clauses are super interesting, where somebody makes an offer. Say, okay, buy me out for $10,000. And if the other guy says no, then I can buy him out for $10,000. So it's one thing triggers the other, and that's where the shotgun idea comes from. That's a super interesting clause. It's one way to deal with it. It's not the only way. But the point is, you got to think about these things. Another D, divorce. So I don't know if it's COVID or what, but we've seen a lot of divorces over the past couple of years. And so let's imagine that you started a business, it's successful, your partner gets divorced, and now the ownership of the business is up for grabs in the divorce proceedings. So, is that a situation you want to be in? Probably not. Is that a situation your original partner wanted to be in? Probably not. Is that a situation your partner's ex wants to be in? Still probably not. Because let's say the court decides, okay, we'll just split your ownership. Now you've got a 50% owner, a 25% owner, and a hostile 25% owner. That's not a good situation to be in. Nobody wants to be there. And in those cases, what tends to happen is business suffers. Maybe it fails entirely, maybe not, maybe just limps along, because you can't put all the focus and energy into the business like it should have been before the divorce. Divorce, definitely want to think about that ahead of time. Drugs, I've seen a number of partnerships go bad because of drugs, and you want to have an out if your partner gets on drugs. That's just all there is to it. And it could be alcohol, it could be illegal drugs, it could be prescription drugs, it could be anything, just whatever. It falls under the same sort of category as disinterest, in that the mechanisms are similar. I knew one partnership, they were doing like a media ad buying play, and the partner that I knew walks in one day and all the computers are gone because the other guy pawned them all for drug money. And it's,
God.
Yeah, it's just, drugs are crazy. I recommend never starting and never getting into business with anybody who's a drug addict, but these things do happen, and sometimes they develop after you start. Have a plan for a way out. And then disagreement, we talked about. That's the one that people do commonly think of when it comes to partnerships and having some sort of resolution process. And the final point here, picking the right partner is 150% of your success. So I was talking to Mike, who wrote this book, and this was my line. Picking the right person is actually more important than the business. The business can only harm the picking the right person decision. So 150% of your success is due to picking the right person. Negative 50% is due to the business itself. I've been on both sides of that, where things have gone poorly, and yeah, it's difficult. If you are a solopreneur, contractor type, there's a lot of people out there who want to do deals, right? It could be a deal like buying a piece of real estate, or it could be a deal like, hey, let's join forces and do some marketing, and you take half and I take half, or whatever the agreement is. And what I want you to take away from this is that, so one, you're going to need an entity to operate. And what you definitely don't want to be in a situation is, we'll just use my entity that I already have and I'll just pay you out. If it's a straight commission kind of thing, then that can work. But if it's something that really requires effort on both parts, it's not a good situation, because the tracking becomes an issue. And did you really get all that money or did you not get this money that I thought you got? And it just creates arguments. So you create a joint venture entity, a partnership of some kind, and then that entity then flows up into your individually controlled entity. That's the first thing that we talked about. At that operating company layer, you want to have these 5 Ds spelled out in advance and in your operating agreement. Say, okay, if this situation develops, here's what happens. If this situation develops, here's what happens. And so as business goes forward, maybe you're lucky, maybe none of these happen, right? And business just goes well and everybody's happy. I can't remember a single time that's actually worked, but I'm sure it's out there somewhere where nobody's disagreed and nobody's had divorces and nobody's become less interested over time. Maybe somebody I don't know, this Goldilocks situation has happened to. But in real life, the 5 Ds happen a lot, and you got to be prepared for them. So you want to have that installed at the operating level, and then the flow-throughs come into your management level. Then you do your tweaking there at individual tax strategies, and then that flows home into your personal income. That's the general framework we want to work with. And obviously, all of this, like I said, highly individual, very unique depending on your individual circumstances. And the planning has to be done from the operating layer all the way back up to your personal layer. And it's a lot. Business is complicated. So that's just the story. As we start to wrap up here, I did want to talk a little bit about next steps. So what I want you to do is actually join our free LinkedIn group. So I'm calling it Tactical Advice Explored. And what this is, it's a LinkedIn group. It's free. You can come, you can go. But that's where we're putting templates and action items. We're going to share ideas, recordings. Generally, we'll do a free blueprint. Tax blueprint is where we assess your situation. We say, okay, if you do this, that, and the other, you can save however many tens of thousands of dollars in taxes. So just, I made a URL link thing. You just go to TaxSherpa.com/group. That will take you to LinkedIn and it'll take you to the right page. And then we're doing these live sessions every Tuesday. And you go to TaxSherpa.com/live, and that'll take you to the page on the LinkedIn. We're actually streaming on YouTube and Facebook and LinkedIn, but the live link will just take you to the LinkedIn page because that's where most of our activity is. And I update that every week so that it'll always go to the next event. So next week is office hours. It's just Q&A, open questions that anybody can chime in on, and then we just go through them, and we'll bring in questions from clients and all kinds of stuff. And then every other week, so like here we're doing partnerships. 2 weeks ago or 3 weeks ago we did the 4-step strategy to save $18,000 on your taxes. And then the next time, we haven't picked a topic yet. This one, I think, Serena, this was your idea, right? The partnerships?
Yes.
Yeah. We'll pick a topic every other week, and then we alternate. So it's going to be office hours Q&A, and then a topic like this, and then office hours Q&A, and then another topic, and then office hours Q&A, and then another topic. But the TaxSherpa.com/live link will take you to whatever the next one is. And we'll update that after each session so that it stays up to date. So those are the two things. Just TaxSherpa.com/group, join the free group, and then we'll just chat about tax issues. Also, non-tax issues like operating elements of the partnerships and the 5Ds, stuff like that. I think it's super valuable, and you can pick up recordings there as well. And then questions. Oh, this is our logo. I forgot about that. The TAX. I thought of that myself, so I'm very proud of that one. All right, the questions. And I have the answer to all tax questions.
Yes, he does.
It depends. So the tax issues are individual. It depends on facts and circumstances. What are the facts and circumstances of the case? What are the facts and circumstances of your situation? So that's why the answer is always it depends. But my favorite tax joke, and we have a couple minutes, so I'll share this one. My favorite tax joke is there's a businessman who's looking to hire new tax accountants. And he calls in 3 different firms. He calls in a big firm, it's got 300 partners, and he calls in a medium-sized firm that has 20 people working there, and he calls in a solo tax guy. So the big firm come in, they do their presentation, here's charts and graphs, and we're going to do this, and we're going to do that, and we've got our team, and blah, blah, blah. And the guy says, great. By the way, one last question. What's 1 + 1? And they say 2, so it's fantastic. They go out the door. Next team comes in, it's the medium-sized firm, and they do their presentation. They say, oh, we're going to give you such special attention. Yeah, we're not as big as those big guys, but you're going to be our focus. You're going to be our number one. All this stuff. It sounds great. And he says, great. Quick question. What's 1 + 1? And they say 2. And he says, fantastic. Off they go. Then the solo guy comes in. He says, hey, I'm Joe. I can do this. I can do that. I can do the other thing. And it says, okay, sounds good. And then he says, quick question. What's 1 + 1? And Joe leans in and he says, what do you want it to be? It says, you got the job. And the reason that is true is because let's say $100 gets deposited in your bank account. What is that? And this is actually a giant problem that's coming up with the 1099K rules that are being implemented this year. $100 gets deposited into your bank account. So what? What is that? Is that a loan? Is it a gift? Is it income? Is it a reimbursement? Who knows, right? Without the context, without the facts and circumstances around what that $100 is, there's no way to determine that. You know, the IRS always determines things in their most favorable light, where all money coming in is income and all money going out is non-deductible. That's always the worst case scenario interpretation. And every tax season, if you go online, you'll see people talking about, oh, tax filing should just be done automatically by the government. They have all the info anyways. So one, no, they don't, because they can see the $100 moving, but they don't know what that is. And two, there is a scenario where the IRS will do your tax return for you. It's called an SFR. It's called substitute for return. And that happens when you don't file for a number of years. They will just mock up a return and put it in the worst possible light. And then they'll send you a letter and they say, you owe $1.3 million, which is what happened to me. Just wait long enough, they will do it. And if you owe money, you'll start getting letters. And if you were due a refund, you'll just never hear about it. It depends, because the situation is always unique. And I'll go on this one little rant here about the 1099K issue. It's a new rule that's being applied for 2023. In the old days, if you were using Venmo, just as an example, and people were paying you less than, there were two criteria. It had to be $20,000 throughout the course of the year, and it had to be 200 transactions. If it was above both of those, then Venmo or PayPal or American Express or whoever would issue a form, 1099K. And it's a third-party transactions report. And it's just telling you and the IRS, say, hey, we're American Express. We process this much money on behalf of this taxpayer throughout the course of the year. And if you're running a business and you're taking American Express, obviously that's all income. So that's fine. It gets a little trickier when you're talking about these more individualized payments. Nobody's taking American Express for their friends to reimburse them for dinner, but they are taking Venmo and they are taking PayPal. So the new rule is forget the 200 transactions. It's any number of transactions, and it's $600 throughout the course of the year. So if you receive $600 or more throughout the course of the year from any number of sources, from any number of transactions through a particular payment channel, then that payment processor has to report to the IRS and to you and say, hey, Bob got $647 during 2023. Now, the problem with this is that, one, it's going to create, the latest estimate is 30 million new tax forms as far as these 1099 reports. And the second thing is, what is that? Because if you're doing a business activity, like I pay my lawn guy, I pay him through Venmo, and I don't know what he was doing before, but for sure now he's going to have to report it. But if you're going out to dinner with friends, that's not income, that's a reimbursement. How are we going to reconcile these 30 million new 1099s, and most of them are going to be not income? And what is the IRS going to do with this information? It's going to be a giant problem, and it's going to fall to the tax preparers like me to actually figure out how to do this. And we're still waiting on guidance from the IRS. My guess is that there's going to be, and this is still a guess, is that in the software there's going to be a field where we can enter non-income 1099 info. We could say, okay, yes, we received a 1099K from Venmo, from PayPal, from whoever, but no, it wasn't income because it wasn't a business activity. It was just a loan, it was a reimbursement, it was a gift, whatever, just not income. Yeah, that's my rant for today. All right.
So Neal, I do have some questions from some clients.
Okay.
I just have 3 questions.
All right.
One of them is the tax filing deadlines.
Yeah.
Client said, what are the key tax filing deadlines for partnerships, and how do they differ from individual tax deadlines?
Yeah, that's a good question, actually. The partnerships and S corporations and trusts, they are flow-through entities. And just like when you get a W-2, you need the W-2 before you file your tax return. W-2s are due by the end of January, rather. They're supposed to be mailed out or sent out, whatever. For partnerships, S corps, and trusts, the due date is March 15th. And if March 15th falls on a Saturday or something, it goes to the next Monday. So that is the deadline for all those forms. Now, what happens is that there are automatic extensions that are granted. You can file what's called a Form 7004 and get an automatic 6-month extension extending the due date for that partnership from March 15th to September 15th. And a lot of people do that because a lot of partnerships don't have their stuff together, or maybe they do and their tax preparer is busy and they didn't get an appointment in time, and all kinds of things can happen. But somebody somewhere is not able to get it done by March 15th. When it comes to your individual filing, you need the form called the K-1. That's like the equivalent of the W-2. The K-1 shows all the flow-throughs from the partnership or S-Corp coming into your individual ownership. And that gets included in your personal tax return. So your tax return is due April 15th, 1 month later. So the problem that people get into is that they tend to either get their K1s like March 14th or September 14th. That's just the way it works, because people are, what is it called? It's Parkinson's law, where the amount of time or the amount of work will expand to take up the amount of time allotted. So if the deadline is March 15th, you're going to get it March 14th. If the deadline's September 15th, it's going to be September 14th, basically, is how it happens. So if you're an owner of a partnership and you're waiting on a K1 that somebody else is doing, then you're stuck on your tax return until you receive that K1. So you can file an extension. In most states anyway, the partnership itself does not pay any tax, because it's a flow-through. The tax impacts hit the individual owners. But you, as the owner, have to pay by April 15th. You can file an extension, but that does not extend your time to pay. It only extends your time to file the papers. If you want to avoid penalties, you got to kick up an extension payment if needed to estimate your tax impact. So the IRS knows that these are like unknown unknowns, meaning that like sometimes you just don't know what it's going to be. I think we had a good year, or I think we had a bad year, but we're waiting on the accountants to finish their thing, and I don't know. There are statutory provisions that basically, as long as you pay at least what you paid last year plus a little more, then you won't be penalized. And that gets rolled in with estimated quarterly payments as well. The key dates are March 15th is original date for flow-through entities. April 15th is the original date for individual and C corporations. C corporations are not flow-throughs, so nobody's waiting on those. So that's that date. Then the extended dates are September 15th for flow-throughs and October 15th for individuals and C corps. And C corps can also elect different years. They could go like July to June, and so they can have weird things. But if your calendar year, those are the basics. And then as far as quarterly dates, you're going to be looking at April 15th for Q1, which covers January, February, March. And then you're going to be looking at June 15th for Q2, which covers April, May, which is 2 months. Then you're looking at September 15th for Q3, which covers May, June, July, August. And then January 15th of the following year for Q4 for individuals, which covers after August, so September through December. And then if you're a C Corp, though, then instead of January 15th of the following year, it's December 15th of the current year. It's this weird pattern. You get 3 months, then 4 months. Or maybe, is it 3, 2, 3, 4? I don't know, something like that. But it's weird. It's not even. If you can, you want to get all those lined up ahead of time, just to at least cover your statutory minimums, and so you don't get any penalties. Now, I will tell you that on that issue, if you don't pay your minimum quarterlies and you end up with a balance owed at the end of the year, then they will charge you an underpayment penalty, but it's not large, right? So it's 3% of the tax. So if you owe 10 grand, it's another $300. Most people, I don't know about most, but a lot of people make a business decision and they say, I'd rather take the hit than lose the cash flow or the use of the cash in the meantime. And then if you really don't know what it's going to be like, then if you don't have a balance due at the end of the year, then you're not going to be penalized. There's that aspect to look at as well. I know we're coming up on the end here, so I don't know if we're going to get all the questions. What was the next one, Serena?
It's a tax credit and deduction question. Client says, are there specific tax credits or deductions available to partnerships that partners should be made aware of?
A lot.
I know. Yeah, I was going to say that's a lot.
Yeah. Where do I start? The big one that a lot of people talk about is R&D. The qualified business income is a huge one. You definitely want to make sure you're optimizing for that we already talked about. There's new energy credits for solar and wind and all that kind of stuff, which are super interesting. They revamped the vehicle credits for electric cars and stuff like that. The electric car one is interesting. I actually wrote a post on our blog about this, about how it is not a carry forward, which was shocking to me. Let's say you buy a new electric vehicle that qualifies and all the stuff, and you get a $7,500 credit. If you don't have a $7,500 liability, then you just lose whatever you weren't able to make use of in the current year. I remember several years ago, we had a client come in, and he was all excited. He spent $20,000, $30,000 on solar panels, and we're like, yeah, but we are optimizing your tax situation. You don't owe $20,000, or you get 30% of whatever things. So his was like a $6,000 or $8,000 credit. So you don't owe $6,000. You owe like $500. And he's, but the sales guy told me, this is why you got to talk to us ahead of time. You know?
Yeah, that's true.
I had another, on the topic of talking ahead of time. I know we're out of time, but we had a client that we were talking to today, and she was telling us that, I had this big event happen over the past couple of years. It's too late to do anything now. We could have done these 3 things, but you're coming to us 6 months after the fact. We're just stuck. Talk to your tax people proactively. That's the big thing. And I know most tax people out there don't do anything proactively. They're not going to help you. You got to find somebody, whether it's us or whether it's anybody else, you got to find somebody that will work with you and form that relationship that you can go through these issues throughout the year, because things come up, right? And no matter what, time changes and business changes. Your situation is going to change. And it's a matter of planning for those changes ahead of time rather than reacting after the fact, after you can actually do anything about it. So anyway, that is us. That's our talk on joint ventures, partnerships, syndications. If you have other questions, go back to the group. Let me see if I can go. Can I go backwards here? How is this working? Let's go to TaxSherpa.com/group. That'll take you to the LinkedIn. Whoop, went too far. TaxSherpa.com/group. That'll take you to the LinkedIn group. You can ask all your questions there. I've been there every day and can answer whatever you like. When people ask about slides and everything, recordings, it'll all be posted there. So with that, I appreciate everybody coming out, and we'll do this again next week, same time, same place, Facebook, LinkedIn, YouTube, and next week will be office hours, so there'll just be open questions. We'll talk to you.